This video is going to discuss rectangle breakouts. A lot of times the market trends and then it goes through a period of choppy sideways action where there's really no buyers, no sellers, maybe people are waiting for a news announcement. For whatever the reason, the market goes in a sideways range. And basically a rectangle breakout, it looks just like a rectangle, and sometimes it goes slightly past the highs or lows. And the time frame from the beginning of the rectangle to the end should be at least an hour or longer. The longer it goes sideways in a rectangle shape, the more likely a breakout is likely to be explosive and worth taking the trade. Any trade where your potential or likely profit is 1.5 or 2 times more than your risk, it's worth taking the trade. And rectangle breakouts have a pretty decent winning percentage, and they also tend to find some pretty explosive moves, which means they're definitely worth taking. The rules are simple. When you see a rectangle breakout and it breaks out later on after it goes sideways through the high of the rectangle, you buy. And if the rectangle high minus low is not that much, you can put your stop underneath the other side, or oftentimes the price stays near the high or near the low before it breaks out, and therefore you can put your stop underneath a few pips beyond that swing. This helps when you follow the right rules. If the rectangle is above the hourly moving average, you're better off looking for buys only when it breaks out over the high of the rectangle. If the weekly trend and monthly trend are up, and the price of course is above the hourly, then your odds go up for a breakout to the upside. If it's above the hourly and it breaks out underneath the low of the rectangle, you still may in some cases take the trade. If the next level of support is far enough away, let's say 15, 20 pips or more, while risking 5 or 10 pips, then it may be worth taking the trade. However, if the next area of support is just right underneath it, then you don't want to take the trade when it breaks the main rule, which is above the hourly buy, below the hourly sell. Just like if it was below the hourly, you wouldn't want to be buying an upside breakout unless the next area of resistance, where there's likely to be some selling, is a good distance away. Let's look at some real-time examples of this in action. Here you can see another good example of a rectangle pattern. Price is above the hourly moving average, and so it's more likely to, when it breaks out of this, to go up. It's also has a daily trend that's up and a monthly trend that's up. Unfortunately, the weekly trend is down, which occasionally happens. And you got in the trade right here. You might have put your stop right underneath the bars that were just right before the breakout. And a lot of times the market goes up, and especially if it's above our upper containment band, it runs out of steam, comes back. But you can see you got in this trade around 14 and price went all the way up to 55. Made a 40 pip move. Here's another good example of a rectangle pattern. Again, they don't always have perfect rectangle shape. Anytime it goes sideways for at least an hour to 3 hours, it's usually a good trade when it breaks out. And you can see this market worked its way up about 20 pips before it ran out of steam. Here's a good example of a rectangle pattern near the lows. The market sold off, was very weak, rallied up and went sideways, and then when it broke out, you want to go short, and the trend continued. Your odds also go up more when you have some of our mentor-only tools, such as the FX Trend Intensity and IntelliTrend. Let's add those to the chart. IntelliTrend, FX Trend Intensity Pro. Anytime you have a movement down that has incredible weakness at or near the 20 level, it's very likely to continue in that trend direction. You can see the market as it went sideways. Notice the bar got really red here even before the breakout, and that added to the probability of it going down. And you can see once you're in the trade, the bars got really dark red, which show extreme weakness, and it just continued down. You might have got out of your trade here for an absolutely huge move in that instance. Here's a rectangle pattern at the low. Notice the daily, weekly, monthly trend are up in this case, and so your odds of a breakout to the upside are a little bit higher probability. Here we have the hourly moving average right above us, so that lowers the odds of this breakout from working. You would have put your stop right underneath this sideways range, so you're risking less than 10 pips here. This was your initial profit target. Once it shot through there, the upper containment bands oftentimes are where the price stalls. Earlier today, you can see this market went down and it went sideways for a number of hours. Notice the price wasn't able to go above this high here, and when it finally breaks down and the bar's red even before it breaks the low, you go short. Now, where do you draw the low of this? Where do you get in when you have one bar that makes a lower low here, but most of the time the price never went below 1.0189 or 88? I typically find the price level where the vast majority, 80-95% of the bars hit and don't go under. If there is a false little breakout earlier in the beginning of the rectangle form, I don't wait for the price to go down underneath here, because most of the time there was some buying here at this level, and so when it breaks that level, I'm in. I'm conscious that it could stall here and reverse back up on me, so as soon as it comes down, I move my stop as close to break even as possible, and in this case, the trade worked. Here's a nice rectangle pattern for many hours, and this is an example of why you don't want to sell the lower end of the rectangle when the price is above the hourly or when the daily, weekly, monthly trend's up, because it's less likely to work and you would have had a loss there. But when it finally broke out to the upside, you can see the price went from around 22 all the way up to 82. It's a 60 pip move. Here's an example of a rectangle pattern that you might have got into a trade here. Keep in mind the daily, weekly, monthly trend's up. It did break down underneath the hourly. It's kind of chopping around the hourly. You might have went short right here. Your stop might have been slightly above the hourly, because once it goes underneath the hourly, oftentimes that acts as resistance. They're selling there, and if it had gone up and acted as resistance there and went down, you would be still in the trade. If it breaks through that level and goes above the hourly, more than likely it's going to go higher, so you might as well have as tight a stop as possible. In this instance, you take the first trade and it fails. You lose money. Once the market starts to go 5 or 10 pips your way, our exit rules are to cut your stop in half, and you might have lost 5 or 6 pips there. Now once it breaks above the high, you're long again with your stop a little bit down here, and it's entirely possible once the price moved up, you would have moved your stop to break even, and you'd have a break even trade here, or maybe another loss, and you have another sideways range. You get into that trade and finally takes off. Like any trading system, it's not about whether any individual trade is going to work or not. It's about the expectancy of the system. If you take every trade where this happens and you subtract off the tiny losses and you stay with the trends that take off and try to maximize the gains on those trending trades, you'll usually find out the trend trades move more pips than what you're risking in most cases. Here the market trended up, and you can see a multi-hour rectangle pattern on here. It's above the hourly. Daily trend's up, monthly trend's up, the weekly trend's down, unfortunately. And when the price breaks out right here, you go long, and your stop's right underneath this little sideways consolidation breakout area. And like I said before, a lot of times you'll find the IntelliTrend bars are green even before the breakout. And that increases your odds of the trade working. And the darker the green, the stronger it is, and it increases your odds as well. You also want to look at the swings down here. Were the up moves greater than the momentum of the down moves? Absolutely. And so the odds of that trade were higher. Here you see a very long time frame rectangle pattern. It's a 30 pip range where the price is going up and down and chopping around with really no clear direction. For the most part, it's above the hourly. The daily, weekly, monthly trend's up. And when it finally breaks out right here, this trend continues and continues. So even if you're a scalper and you get out of it with a quick 10, 20, 30 pip move, or you just keep trailing your stops up, or you draw your fibs on the move and you get out here at this fib target of this previous move, whatever you do. And you can also see another multi-hour consolidation rectangle pattern happens again later. And again, I oftentimes, even though the high of it is right here, if the vast majority of the bar's highs are lower than a few 1, 2, or 3 bars that peak above it, after it forms, the longer it forms, the more likely it is to break out. And so I might get into one of these trades a little bit earlier here at 35 versus 40. And that way, if it goes up to the high, I've already moved my stop in half. And when the trade takes off, you have a few extra pips.